Today, silver's up over $2 again to over $64. And so what was supposed to scare the market just turned in, to kind of a shakeout rather. And the leverage got cleaned out and the available silver got tighter and the price floor got stronger. And this is happening at the same time rates are rising in London again. Lease rates there about 8%. How London silver has been the linchpin of all of this, where, their paper claims are backed by very little metal, somewhere around 2 billion ounces of paper claims backed by about 140 million ounces. JPMorgan, by the way, the Economic Times just came out with a report saying that they hold over 750 million ounces of physical silver, and that's worth more than $40 billion. And that in 6 weeks, JPMorgan added 21 million ounces while closing a 200 million ounce paper short position. So by removing that paper short, they remove the pressure that keeps the price down, and while buying the physical metal, well, this is going to push prices up much higher.
Silver is up more than $2 again, trading above $64, as what was expected to rattle the market instead triggered a powerful shakeout. According to precious metals expert Andy Schectman, excessive leverage was flushed out, available silver supplies tightened, and a stronger price floor emerged. At the same time, London silver lease rates have climbed to nearly 8%, exposing how fragile the paper-silver system has become. With billions of ounces in paper claims backed by minimal physical metal, pressure is building. Adding fuel, JPMorgan recently accumulated 21 million ounces of physical silver while closing massive paper short positions, removing artificial price suppression and setting the stage for significantly higher silver prices. Now, we present the clips from Andy's Schectman interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
BlackRock, of the world's largest silver trust, you would think it would be far easier and more palatable for the world when they look at the world and say, well, what? All we did was close SLV, unless you have a basket, which would be millions and millions and millions and millions of dollars worth. These are the people that actually fund the account typically. Like the commercial banks, none of us can take possession of it anyway. So it's an asset that tracks the price, or it's an ETF that tracks the price of silver, and not even that great at that, but it is the largest silver trust in the world, and it would be far easier for JPMorgan to close that account, pay everyone their fair share of what their account was worth at the end of business on Friday, and say to the world, all we did is what the prospectus allows us to do. Now you're sitting on a huge stockpile of silver without breaking any laws or infringing any civil liberties. And, it gets interesting when we talk about JPMorgan, by the way. The Economic Times just came out with a report saying that they hold over 750 million ounces of physical silver, and that's worth more than $40 billion. And it would be the largest stockpile on the planet if that were the truth. The report is very interesting. It says they didn't just stop shorting silver, they actually flipped and became the biggest long in the market. It said that in 6 weeks, JPMorgan added 21 million ounces while closing a 200 million ounce paper short position. So by removing that paper short, they remove the pressure that keeps the price down. And while buying the physical metal, well, this is going to push prices up much higher. They also mentioned that they took 16.6 million ounces out of the registered inventory, and it left COMEX completely gone. We don't know where it went. And when 16 million ounces leaves COMEX, it ain't coming back ever. That would be my guess, an industrial. Silver is what's called a Giffen good. What Giffen good means is the higher the price goes, the greater the demand. Most assets don't work that way. They say the cure for high prices are higher prices. Not with silver, because you have the industrial component of it where you need it to make your Tesla, you make your iPhone, to make your solar panels. And Samsung, which is one of the things you and I talked about offline there, the rumors are that, yeah, they've been flying around or Samsung flew to Mexico and to strike a deal. But this is what a Giffen good would be. If you need that silver, and it's called inelastic, by the way, silver is inelastic, which basically means you only need $30 worth of silver to make a $1,500 iPhone. You don't care what the cost of silver costs. You need it. and it represents a very small price or a little bit in a high tech, relative in terms of its cost, a few hundred ounces, maybe in a military grade missile that sells for $5 million. You don't care what it costs. You must get it. And so you get all of these entities fighting with one another, so to speak, a battle between the industrials and the investors. So when you see that kind of metal actually move and leave the marketplace, it's something to watch and be very cognizant of. They also talked about the fact that they moved somewhere in the neighborhood of like 166 million ounces of silver. They moved it 169 million ounces of silver, and they moved it into what's called a non-deliverable vault. Now, this was something that was new to me. I dig in a little bit because I thought either it is or it isn't in the COMEX ecosystem. And it technically, these 169 million ounces, technically they still exist on paper and could be moved into COMEX, but it's legally removed from the delivery system, and it cannot be used for COMEX settlement unless it is re-registered. So, not only have they accumulated 750 million ounces of silver, and they have forever always been the biggest short, but they've flipped from short to long. They added 21 million ounces while closing a 200 million ounce paper short, according to this article. And then at the same time, 16.6 million ounces left the registered category, left the building. Goodbye, silver. And 169 got moved into vaults outside the COMEX deliverable status. This is not defensive posturing at all. This is intentional removal of metal from the delivery pool. And if it is true, it marks a huge shift from suppressing silver with paper to accumulating physical metal. And you want to talk about bullish. At the same time, and you can stop me anytime here, COMEX deliveries have been unusually large all year, Kaiser. In November, which is typically not a delivery month, we had almost 17 million ounces of silver and about 1.5 million ounces of gold that were delivered. In both cases, gold and silver, it's not a delivery month. By just the 12th of December, deliveries have already reached 58 million ounces of silver and almost 3 million ounces of gold, with contracts still being added daily. Now, ask yourself this question, and this is what I've been trying to scream to people. I don't care what the price is doing. It doesn't mean anything. What does mean something is that the people who in just a handful of days deliver, 58 million ounces of silver and almost 3 million ounces of gold. Who's got the money to do this? You're talking billions and billions and billions and billions every single month. For years, gold and silver has flown back and forth between the COMEX and the LBMA, and these Western banks were in concert together to suppress the price of gold and silver. Now, silver, I would argue, was suppressed for the military-industrial complex. That wasn't just the United States. It was France. It was England. It was all of the, all of the Western countries that had strong militaries that used that to keep their thumb on the world, so to speak. And at the same time, gold was used to hold down the price of gold, largely through futures contracts where they go short in New York to drive the price down and go long in London to offset their books, and metal would flow back and forth. And this was done in cooperation between all of the banks in the West. Gold was held down because of something called Gibson's paradox, which speaks to the inverse relationship between real interest rates and the price of gold. So if the West suppresses interest rates for 30 years to create an illusion of prosperity in our 401ks and our house values and keep everyone, borrowing from the bank, using currency, buying bonds, all of the things that the Western bankers would want, you step on the price of gold.
Precious metals analyst Andy Schectman, CEO of Miles Franklin, is sounding the alarm on what may be the most bullish structural shift in the silver market in decades. At the center is BlackRock's SLV, the world's largest silver trust, and JPMorgan's quiet but massive repositioning. Schectman explains that SLV functions purely as a price-tracking ETF, with no realistic path for retail investors to claim physical metal. This makes it far easier for institutions to close positions while retaining underlying silver stockpiles. According to a recent Economic Times report, JPMorgan may now control over 750 million ounces of physical silver, worth more than $40 billion, while simultaneously flipping from the largest paper short to the largest long. In just 6 weeks, they added 21 million ounces, closed a 200 million ounce paper short, removed 16.6 million ounces from COMEX registered inventories, and shifted another 169 million ounces into non-deliverable vaults. With industrial demand inelastic and COMEX deliveries exploding, Schectman says the intentional removal of silver from the market points to dramatically higher prices ahead. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos.